Millions of Americans think earning more puts all their income into a higher tax bracket, but that is not how the system in 2025 works at all. Most people do not realize only about 7% reach the top two brackets, and many lose out by fearing raises or by missing key deductions. The truth behind federal tax brackets could mean keeping thousands this season, but almost everyone misunderstands it. What you are about to learn will change how you look at every paycheck, starting with breaking one of the most costly tax myths in America. This information is for educational purposes only. Seek a qualified tax professional for personalized advice. A single mom in Ohio stares at her pay stub, debating whether to take extra shifts. She has heard from friends and family that working more could actually leave her with less money once taxes kick in, creating fear. Across the country, a warehouse worker turns down overtime, convinced a few extra hours will bump his entire income into a higher bracket and wipe out his gains. This myth shows up in break rooms, on social media, and in some financial advice columns. The fear is real. Many Americans believe one wrong move on a paycheck could trigger a penalty instead of a reward. Behavioral studies show this anxiety drives people to decline raises, bonuses, or side gigs. It is not laziness or lack of ambition. It is a reaction to a system they are told is stacked against them. The myth is so powerful that even seasoned professionals hesitate to negotiate for more, worried about a tax trap that does not actually exist. The truth is, the U.S. tax system does not punish you for earning more. Instead, it uses a layered approach where only the portion of your income above each threshold is taxed at the higher rate. But when fear takes over, people leave thousands on the table, money that could have gone to savings, debt repayment, or family needs. Before looking at any numbers, it is important to clear away this fog. The next step is to see exactly how these brackets are structured and why the reality is far less punishing than the myth. This video is for educational purposes only. For advice on your specific situation, consult a qualified tax professional. 7 tax rates define the 2025 federal income tax ladder: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Each rate applies to a specific range of taxable income, and for single filers, these ranges are set by precise thresholds. The first $11,925 falls in the 10% bracket. From $11,926 to $48,475, the rate is 12%. The 22% bracket covers $48,476 up to $103,350. Income between $103,351 and $197,300 is taxed at 24%. The 32% rate begins at $197,301 and runs to $250,525. From $250,526 up to $626,350, the rate rises to 35%. Only income above $626,350 faces the 37% top rate. These brackets are progressive, so each dollar only gets taxed at the rate for its own slice. For a single filer with $40,000 in taxable income, the first $11,925 is taxed at 10%. The next $36,550 is taxed at 12%. None of their income touches the 22% bracket. This means most people never see the higher rates on their tax bill. Fewer than 1 in 10 single filers reach even the 32% bracket. Crossing that line takes taxable income above $197,300. The majority of Americans fall somewhere in the 12%, 22%, or 24% brackets. The 37% rate is reserved for the highest incomes, a level that is out of reach for nearly everyone. These numbers set the stage for understanding how your filing status changes the picture and why comparing single to joint returns is so important for planning. Educational disclaimer: this information is for educational purposes only. Seek a tax professional for advice specific to your situation. Before any tax bracket applies, a large portion of income is protected by the standard deduction. For 2025, the standard deduction is $15,750 for single filers, $23,625 for head of household, and $31,500 for married couples filing jointly. This deduction acts as an untaxed pocket, money that is completely shielded from federal income tax, no matter your bracket. For most people, this means the first dollars they earn are not taxed at all. It is only after subtracting the standard deduction from total income that the tax brackets come into play. Filing status shapes the entire tax calculation. Married couples who file jointly get double the untaxed cushion compared to single filers, and their bracket ranges are much wider. For example, the 10% bracket for single filers covers up to $11,925 in taxable income, while for married filing jointly, it extends to $23,850. The top bracket for joint filers does not kick in until taxable income exceeds $751,600 compared to $626,350 for singles. Head of household status, often used by single parents or caregivers, offers a standard deduction of $23,625 and wider bracket ranges than single status, which can lead to significant savings. Choosing the right filing status is not just about marital status. It can mean thousands of dollars in tax difference. For example, a married couple with $80,000 in combined income who files jointly will see their first $31,500 go untaxed and enjoy lower rates on the rest, while two single filers would each have less income shielded and reach higher rates sooner. Filing status is the first lever in adjusting taxable income, and understanding these thresholds is key to planning ahead. This information is for educational purposes only. Seek a tax professional for personalized advice. A financial planner sits across from a client earning $60,000 a year, calculator in hand. They walk through the numbers line by line. The planner points out that while the client's top tax bracket is 22%, their effective tax rate, the actual percentage of total income paid in federal tax, is much lower. On $60,000, after the standard deduction, the tax bill comes to about $5,100. That is an effective rate of roughly 8.5%, not 22%. For someone earning $80,000, the effective rate rises to about 11.5%, with a total tax bill near $9,200. These numbers show that most people pay far less on average than their highest bracket suggests. The conversation turns to raises. The planner asks, what if you get a $1,000 raise? Many people worry that extra money will be swallowed by taxes. In reality, only the part of the raise that falls into a higher bracket is taxed at the new rate. For a single filer moving from $60,000 to $61,000, the additional $1,000 is taxed at 22%, costing $220 in federal tax. The rest, $780, goes straight into take-home pay. The myth that a raise could leave you with less money simply does not hold up. Every extra dollar increases net income, though the tax on that dollar may be higher. Pre-tax contributions offer another tool. A $10,000 contribution to a 401k reduces taxable income dollar for dollar. For someone in the 22% bracket, this move cuts their tax bill by $2,200. The money grows tax deferred, and the immediate savings can be significant. These strategies, understanding effective rates, accepting raises, and using pre-tax accounts, are the foundation of smart tax planning. This information is for educational purposes only. Seek a qualified tax professional for personalized advice. Tax credits are a different animal from deductions. While deductions shrink the amount of income that gets taxed, credits cut the tax bill itself, dollar for dollar. Take the child tax credit for 2025. It is worth up to $2,200 per child, and it comes straight off the bottom line. A married couple with 2 children and $150,000 in taxable income could see $4,400 erased from what they owe, not just from their income. Credits like this do not just soften the blow, they can wipe out liability entirely for some families. As one CPA explains, a $2,200 credit is like finding $2,200 in your refund, no matter what tax bracket you are in. For higher earners, credits can mean the difference between owing money and getting a check back. The impact is immediate and powerful, and it is one of the most overlooked tools in the tax code. This information is for educational purposes only. Seek a professional for more information. December 31st isn't just a date on the calendar. It is the deadline for making moves that can lower your 2025 tax bill. Start by checking your pay stub and make sure your Form W-4 withholding matches your actual tax situation. Too much. Withholding creates large refunds but smaller paychecks all year. Next, gather receipts for donations, medical bills, and home office expenses. If you have investments, review your portfolio for losses that could offset gains. This is tax loss harvesting. Max out contributions to your 401k, your traditional IRA, or your HSA before the end of the year to reduce taxable income dollar for dollar. Keep all documentation organized in case the IRS requests proof. Every action, adjusting withholding, tracking deductions, and harvesting losses, must be completed by December 31st to count for this tax year. This information is for educational purposes only. For advice tailored to your situation, consult a qualified tax professional. Every April, tax policy shapes millions of real-life decisions, and the brackets for 2025 are no exception. As Congress debates new deductions and credits, understanding the rules is not just trivia, it is money left in your pocket. For personalized advice, consult a tax professional. This information is for educational purposes only, and you should seek a professional for more information. Your next move is yours to make.